The Klarna Group PLC stock, trading under the ticker KLAR on the NYSE, is currently sitting at $34.27 as of the market close on November 17, 2025. That closing price represents a minus 1.01% move on the day, a modest dip that belies the dramatic financial narrative unfolding behind the Buy Now, Pay Later, or BNPL giant. The stock has been highly volatile since its recent IPO, and while the day's move seems minor, the bigger picture shows a significant churn near the bottom of its post-listing range. Investors came into this period with high expectations following the company's Q3 earnings announcement, which revealed record revenue and a forecast for their first billion-dollar quarter in Q4, but the reality is more nuanced. The market is clearly still focused on the ballooning credit loss provisions, a critical financial headwind that acts as the anchor dragging down a fundamentally growing business. That tension, record revenue growth clashing with rising risk provisions, is the core dynamic driving Klarna stock right now. It is a classic expectation versus reality situation for a fintech company operating on a lending model. The consensus view for Klarna, especially among growth investors who watch names like SoFi Invest or consider the innovation seen in the Robinhood app, is that it's a category leader in a rapidly expanding sector, transitioning from a pure BNPL platform to a broader digital shopping and payments online investment ecosystem. The expectation is that its massive scale, over 114 million active consumers and 850,000 merchants, will eventually translate into sustainable, substantial profit, much like the path taken by other successful high-growth tech companies. However, a deeper dive into the recent trading pattern shows institutional skittishness. The fact that the stock is trading so close to its 52-week low, despite the optimistic Q3 guidance, tells you that the market narrative is still dominated by risk-off sentiment. The stock has been under continuous pressure, having fallen below its $40 IPO price shortly after debut, and the recent positive earnings failed to provide the lasting catalyst many hoped for. High trading volume days often coincide with sell-offs, suggesting that early investors and institutions are taking profits or simply reducing exposure due to broader macroeconomic concerns, particularly the sensitivity of credit-reliant fintechs to interest rate fluctuations. Even with the U.S. Federal Reserve potentially cutting rates, the specter of higher capital costs and credit performance remains a significant headwind, something that managers of an intelligent portfolio would certainly flag as a risk factor.